talking about reopening. I was going to ask you about casinos because that's gone the opposite way. But you're saying buy weakness where you don't have the policy risk. Where would that be?
Absolutely. Well, we downgraded China a couple of weeks back to neutral, so there's definitely policy headwinds. But the whole market actually derated, and we see actually opportunities in the green tech space. That's something which is a priority. Also, with the prospects of being carbon neutral in 2060. We're looking at the consumer side because definitely China wants to have more domestic consumption, and that's definitely a sector where they will actually allow to grow, and also there will be less policy headwinds. And then a bit more cyclical, we also like energy, but that's probably more because oil is still trading higher. A lot of energy stocks haven't really basically priced this increase in oil price we have seen over the last 18 months.
Is the cyclical trade, the last one you mentioned, is that coming up against the Delta variant narrative, really? Because you're starting to see that come up in not in all places of the world, but various metrics of growth are starting to really roll over now.
Well, the reflation trade has been challenged over the last couple of weeks, absolutely. And we see oil actually this week probably down around 5–6%. So we definitely see the impact. But historically, so these uncertainties about Delta variants or other waves that we have seen has always been a buying opportunity because it's just postponing basically the recovery. And once we have seen sort of the peak of the uncertainties, actually these sectors have started to outperform. So it's a good actually opportunity to add to these trades.
We woke up this morning and the headline was U.S. stocks, new record again. Europe, we know where that is, also quite new records there. But Asia, EM, and everything else and the gap is I can't seem to remember the last time the divergence in performance was this, was this massive. When do we start to fade some of the better performers and move into these unloved parts in terms of geographical exposure?
Well, EM, Asia, China trading 30% discount to the developed markets like Europe and the US. It's probably also a reflection of different approach how to handle the COVID. They are opening up. We here are still talking about lockdowns and have restrictions, and that's a reflection. Earnings growth is strong. But we actually were looking a bit more granular, and it's really China that is dragging down Asia. It's dragging down the EM market overall. And so it's about when do we have less headwinds from the policy in China? I think that will be the moment where Asia, EM actually can have a return. But it will be still a difficult second half in our view.
A lot of flows still into fixed income, massive, whether that's structural or speculative. You look at where Chinese bonds are, for example, the U.S. 10-year, we're closer to 1% now. What would that be in your portfolio as we speak?
Well, we're still underweight bonds. We do think that the yields, the 10-year, is too low at this point. There's some technical reasons, probably lots of liquidity that has been driven into the market, and that's looking for a new home. But looking at where the economy is, yes, we have the Delta variant at the moment, but the reopening will push yields higher. So we actually do think 10-year Treasury should be rather trading around 2 than where we are now. And that should also basically rebring this reflation trade, reopening trade, financials, which usually do well during this period.
Investment grade credit, you don't like? No, too tight?
Too tight. I think the CGB bonds, that's something we're long. So we see that Chinese rates are coming off. They have more headwinds. The policy maybe went a bit too far, growth slowdown. There will be some easing now probably going on. That's an opportunity. But otherwise, we still like the more risky part. So high yield is definitely something we still do like in the US, but even here in Asia.
So high yield takes us into China. Some of these B-rated, and the spreads have just exploded because of the Evergrandes of the world and the Huarongs of the world. I would imagine there's value there. You got to be careful, though. Would you be recommending looking at that?
Well, you have to be selective, but absolutely. So we are still overweight, most preferred on Asian high yield. 50% is non-China. We see, for example, Sri Lanka has improved. Absolutely. On the Chinese side, yes, the property side is definitely challenged, but the spreads are now trading above 1,000. So we start to see value. You have to be selective. We think it's more idiosyncratic risk than really systemic risk for the sector, and therefore there are opportunities, but you have to be careful what you're buying.
This week, a lot of central bank decisions and changes, if you will. I mean, you had the RBNZ, again, hawkish, RBA kind of hawkish, BOE hawkish overnight. Currency exposure, where do you want to be? Where don't you want to be?
So we used to be dollar bears. we have basically neutralized this view.
Okay.
We are more neutral. We think, as you mentioned, a lot of central banks start to look into tapering, start to look into the inflation numbers and thinking about changing their monetary policy. So we're sort of an inflection point for some of the central banks. The US will be definitely one of them. We think fundamentally the US dollar is a weak currency, but the prospects of the tapering discussion and announcement over the next couple of months could actually bring forward the US dollar side.
Yeah, I mean, just very quickly there on that, as a final question, do you think tapering happens this year or next year?
The tapering will start next year,
Okay.
but the discussion will be more vocal in August, most likely in September. Announcement, our base case is December, maybe brought forward to November, starting in January. That's our prospects.